In this video, I will be sharing a powerful secret about the RSI indicator that will change the way you trade. If you watch this video carefully and apply the knowledge with practice, you will have gained the ability to enter the trends on the pullbacks at the right time. The strategy that I will share today is very simple. I have extensively tested this strategy on the stock market and it does have a good edge. Across my backtest, the strategy has provided a 68% win rate. As an individual metric, the win rate is not as high as you might expect. But let me tell you that most professional traders would take this win rate in a heartbeat. The place where the strategy shines is that on each trade we expect a minimum RR ratio of 1.5 is to 1. So, for every 1% stop loss, we will keep a minimum 1.5% target. Now, when we combine the risk-reward ratio with the win rate, we have a genuinely powerful strategy that can be robust in almost all market conditions. So the burning question is, what is the strategy? Let's get into the strategy. The strategy that we will discuss today is based only on one single indicator. That is the RSI indicator. RSI stands for Relative Strength Index. The RSI is a momentum indicator that is widely used in the technical analysis community. I think most of you viewers will be aware of the indicator, but for the new learners, let me give a brief introduction. The RSI is a simple indicator that measures the recent change in price to mark overbought and oversold levels that act as reversal points. The value of the RSI revolves between 100 and 0. Another important variable in the RSI is the period over which the calculations will be made. By default, most of the charting packages provide a 14-period RSI. This means that the RSI will measure the movement over the last 14 candles. In my experience, I find the 14-period RSI to be good enough most of the time. Some people like to use shorter 2, 3, or 4-period RSI. But for this strategy, we will stick to the 14-period RSI. Now, let's understand how are reversal points identified using the RSI. Generally, when the RSI crosses above the value of 70, it is considered overbought and we expect the price to fall. On the contrary, when the RSI goes below the value of 30, it is considered to be oversold. Therefore, we expect the price to make an up move. Now, most traders learn a little about the RSI and immediately think they can sell every time RSI goes above 70 and they can buy every time the RSI hits 30. Well, in theory that sounds simple and effective, but in reality, this strategy would fail miserably. In reality, during strong uptrending markets, we see that the price can continue upwards beyond the 70 levels on the RSI. Similarly, in a strong downtrend, the price can continue the down move beyond the 30 levels. The reason this happens is that the market scenarios change from time to time. Therefore, it becomes essential that we use the indicator in accordance with the current situation or scenario. This is where our secret strategy comes into place. The strategy that I will share today is based on the concept of RSI power zones that was introduced by a trader named Andrew Cardwell. Andrew studied the RSI indicator for several decades and developed some observations about the RSI in relation to the price. The RSI power zones are one of these observations. He discovered that the standard 30 to 70 levels were not respected all the time. On the contrary, the oversold and overbought levels shifted with a shift in the trend. According to the concept of power zones, when the price is in an uptrend, the overbought region for the price can be around the 80 level. And the oversold level for the price will be around the 40 level. This means that, in an uptrend, the RSI will generally revolve between 80 and 40. If the price breaks and sustains below 40, we can think of this as a sign of weakness in the uptrend. When we see such a sign, we can expect the uptrend to be over and a major down move or sideways range may be established soon. In a downtrend, the overbought region for the RSI will be 60 and the oversold region will be 20. In other words, a downtrend will see the RSI revolve between 60 and 20. If the price breaks and sustains above 60, it will be an indication that the downtrend may be over and the price may move upwards or sideways. This concept of shifting zones on the RSI is the key to our strategy. Now, let us dive deep into the specifics of the strategy. This strategy is a swing trading strategy and we will use the daily timeframes to enter and exit. Another characteristic of the strategy is that it is a long-only strategy. This means that we will look at buying trades only. This is because we will be looking to hold on to trades for approximately 5 to 7 days. And generally, the markets do not allow to hold short traders for 5 to 7 days. So, it becomes necessary to look only for buying opportunities as they are straightforward to execute and maintain. A buying opportunity will occur for us when the stock is in a strong uptrend. To find such stocks, we will scan for a liquid group of stocks that are within the 20% range of their 52-week high. This essentially means that if the 52-week high of the stock is $100, we want the current price to be above $80 to be considered as a potential buying opportunity. Once you filter these stocks, you will notice that almost all of them are in an uptrend. An uptrend can be identified using the price action. If the price is making higher highs and higher lows, it is said to be in an uptrend. On the other hand, if the price is making lower highs and lower lows, it is said to be in a downtrend. We can also use a simple moving average to identify the trend. Most of the time, I like to use a simple 200-day moving average for the identification of the trend. If the price is trading above 200 MA and the moving average is sloped upwards, we can call this an uptrend. Once we have the list of the stocks, we will filter out the stocks that are in an uptrend. The next step is to use the RSI zones for our entries. In an uptrend, we know that the RSI will generally be between 40 and 80 level. So, we have two types of trades in an uptrend. We can either short the stock when the RSI crosses above the 80 level, or we can buy the stock when the RSI is below 40. The short trade will be a counter-trend approach, and the buy trade will be a trend-following approach. If we look at simple probabilities, a trade initiated in the direction of the trend will have a higher probability of profit than a counter-trend trade. In other words, buying on oversold levels will have a higher chance of success rather than selling on overbought levels. Therefore, whenever the price makes a pullback and the RSI goes below 40, we will look to enter a buy trade. Here is an example. On this chart, we have the Bank First Cooperation on the daily chart. Here, we can see that the price was in an uptrend. We see the price make higher highs and higher lows. We can also see that the price was trading above the 200-period moving average. The moving average was also sloped upwards. All of these things confirm that the price was in a strong uptrend. So we were looking for good entry points to trade the uptrend. And as discussed earlier, these entry points were the RSI power zones, which is the 40 level. On this chart, we see two entry points. The first entry occurred in late November of 2021. The price had just broken above the 200-period moving average and it had formed a range right above the MA. On this candle, we see that the RSI moved below 40. So, this was a good area to enter a buy trade. But, we need to look for other confirmations that can help us in pinpointing our entry. I like to use candlesticks to confirm my entry. We need to look for green candles that close near its highs for the entry. On this setup, this candle would be our entry trigger. It is a wide-range hammer candle that closes near its highs. We can place an entry above the high of this candle. We will keep our stop loss below the low of the candle, and we can target a RR ratio of 1:1.5. And as you can see, the price did eventually achieve our targets. Let's look at the second setup. This setup occurred very recently in May. We see that after a decent up move, the price starts to make a pullback. On this candle, the RSI touches the 40 level. Therefore, it is now a good time to look for an entry signal. Again, for our entry, we want to see the price make a bullish green candle that closes near its highs. On this chart, this is our entry candle. The candle is a small-sized green candle that closes near its highs. So we keep a buy order above its high. On the next day, the price does not trigger our entry, but once we place our entry order we will wait for a couple of days to get our entry filled. On this candle, the price finally triggers our entry. So we enter. We can keep our stop loss below the most recent swing low, and we can place our targets at 1.5 times the risk. And as you can see, the price achieved our targets on this trade as well. That brings us to the end of this video.